All right, I'm going to get started. So first things first, what we're going to be doing is, this is for stock trading. So if you guys are in here for crypto, stick around. I'm going to go over the Bitcoin technique after this. But this is going to be for penny stocks. What I mean by penny stocks is the technical term for a penny stock is, I believe, any stock below $5. When most people hear penny stock, they think, oh, it must be pennies. It must be below $1. That's not true. Technically, I believe it's below $5. What I do is I trade anything below $7. So anything from $1 to $7 is the range that I look at. I don't trade anything below $1 because they just don't seem to move in the same patterns. They don't seem to move kind of in the same with the same momentum as the stocks above $1. So I look for stocks from $1 to $7. So what we're going to look for here is, if you're on TradingView, if you guys want to follow along, just pull up a TradingView chart, grab the stock screener down here at the bottom. Let me make this a little bigger so you guys can see it. So the first thing I do when I'm trading penny stocks is, you want to have a screener. It doesn't have to be on TradingView. It can be on Thinkorswim, or what's another one? Trade Ideas, FinViz. There's a lot of screeners. I typically use TradingView and FinViz. If you guys don't know what FinViz is a really valuable screening website for equities. You can look up basically any equities on here. Like, for example, you could do like Apple, and it will give you a ton of information. I mean a ton, guys. This website is invaluable. It gives you all kinds of information on their targets, their earnings, their cash flow, employees. As you can see, there's tons of stuff here. ROE, ROI, margins, share floats. So if you're looking into like swing trading or investing in stocks, FinViz is a great website to use. They also have a screener, which is pretty good, but if you don't have their paid version, it's a little delayed. If you have the paid version of TradingView, this is not delayed. This is live. Okay, so once you set up the screener, what you're going to do is go over here to this little columns button, the column setup, and grab all of these that I have here. Change percentage, description, EMA 10, EMA 20, EMA 50, buy, last, relative volume, shares float, and volume. It doesn't matter what order you put these in. You can put them in whatever order you would like. The way I have it set up is, I have it, obviously the name of the stock is over here. Then I have the price of the stock, what the high of the day is, the change, so what is the percentage change in the day, volume, so you want to see how much volume it's trading, relative volume, how much volume is it getting compared to its average, float, how many shares does this ticker have, what's the supply, and then I have the EMAs. So I'll get into that a little bit later. So once you have these laid out, then you want to add in some filters. So what filters I use is, you go to the last, you want to do between $1 and $7. That's what I look for. You can do whatever you want to look for. But if you're trading penny stocks the way that I do, I look for 1 to 7. The high, you don't need a filter. Change percentage, you want above or equal to 5. So you want stocks that are doing well. You want stocks that are up 5% or higher. Next, volume. You want to see you want to see stocks that are doing 250,000 or higher in volume. Nothing below 250,000. If you want to be even a little more picky, you can go 500,000. But I do 250. Relative volume doesn't matter. You can filter it to only do above 1, which is basically what we look for, but you don't have to filter that. Float. This is very important, guys. This is probably the most important filter on this entire screener. You want it to be 50 million to 200 million. Nothing below 50 million unless you want to get into some seriously risky penny stocks. Nothing above 200 million. So you want to get 50 million to 200 million. If you guys don't know what float is, that is how many shares are tradable on the market. Okay. Next, your EMAs. You don't need filters, but if you want to, you can filter the 10 and the 20 to have buy signals. The 50, you don't really need a buy signal, but you can filter the 10 and the 20 to have buy signals. I don't have them filtered because I don't want to cut out too many trades. Okay, so that's our screener. We have it set to just auto refresh, I think, every 10 seconds. That's if you have a paid version of TradingView. If you don't have a paid version, I think you have to manually refresh it. But once this, I should have probably made this video when the market was open so you can kind of see the scanner in action. But once this is running, it will scan for basically everything that fits our criteria. And then we usually get about 5 to 15 matches. On Friday, we didn't have any. I think we only had one on Friday. But typically we get about 5 to 15 matches. And what I do is you just click through them and you look for very certain patterns. And I'm going to go over right now what those patterns are. Let me close the screener. First, let me throw on my indicators that I'm going to be using for this setup. So I have an indicator that is just a 12 moving average. The only thing fancy about it is it turns green when it's rising and it turns red when it's falling. If you don't have this indicator, you can just throw on a standard 12 moving average or whatever short term you like. You can use like a 10 or a 15, but I use a 12. Okay, the other indicators I'm going to be using are my DBT Momo. There it is. And I'm also going to be using MACD. Default Momo, default MACD. Let me go into the Momo here and turn off the candle colors. Okay. It's actually going to be hard to... Actually, here I know what I can do. Since the market is not open and we don't have a lot of things to look at, let me pull up some recent ones that I posted in Discord that were fitting my technique pretty much perfectly. Which ones were they? They were... ASNS was one of the big ones. We also had TYME and I think that's good for now. That's actually, I can use these perfectly. Okay. So when you're scanning through these coins on the scanner, on the screener, what you want to look for, oh, actually, here, I forgot something. I need volume. Okay, so when you're scanning for these with your screener, when you pop on the chart, you want to see during that opening session, that 9:30 to like 10:30, you want to see that surge in volume because the screener is telling you that it's getting a surge in volume. Because remember, we filtered it to find stocks that are doing 250K in volume or higher. So you want to make sure that it is getting a surge in volume, and you want to make sure that as price is rising, so is volume. And if price is falling, so is volume. This is a bull flag setup. This is the main pattern that I look for when I'm trading penny stocks. If it is not in a bull flag or a somewhat relative to a bull flag pattern, I do not trade it. This is the only pattern that I look for. There are sub patterns kind of inside this bull flag that I look for, but the number one pattern is the bull flag. So once again, you want to look for a surge in volume on the opening bell. You want price to be rising with the volume, price to be falling with the volume, so high volume, low volume. And then when we start to curl back, this is typically where your 12 moving average comes in. You want the 12 moving average to be supporting price, as we saw here. We started to dip below it a little bit here. You can see it supported price basically the entire way up. This is a perfect setup. Even this dip here below the 12 is fine because look at volume. We see a surge in price, 12 moving average acting as support. Our MACD is crossing up. It is above the signal line. The Momo is crossing up. We're showing bullish momentum in the Momo. And then as price starts to consolidate or fall here, like we fell a small bit there, probably a few percent. Let's see. That was actually a pretty big fall, 18%, 44 cents. If you would have gotten a little early there, you definitely would have got chopped out. So we had a test of the 12, consolidate, look at volume. The volume is failing. Now, look, when price starts to rise again, look at volume. Volume starts to pick up. You have a pretty serious pullback here because volume was pretty high. But then we have decreasing volume. And then once again, look at price. Price is going up. Look at volume. Volume is going up with price. This is the pattern that we look for on a day-to-day basis when we're trading penny stocks. So some of you are probably wondering, how do you trade this according to what's my target? What's my stop loss? Where do I get in and out of these trades? Okay, so depending on the time of day that you're trading, you want to usually get in these in the first 30 minutes to an hour, depending on how strong of a pattern it is right out of the gate. You typically want to trade these around 9:30 to 11:30. So that first 2 hours. You typically want to be in the trade by the first hour, but if you have to get in the trade by the second hour, it's okay. If you're not in the trade by 11:30, I would not trade during lunch because that's typically when you have a decrease in volume. That is a perfect time for you to see if the bull flag is a proper bull flag. Because what you will see is if price is surging on the opening bell, when you get towards, let's say this is like 9 o'clock, when you get towards that lunchtime, that 12 o'clock time, if it's a proper bull flag, typically that's when you'll see that decrease in price and you'll start to see that flagging pattern. Once it comes back to around 2 p.m., towards the last hour of the day, that is when you'll start to see that second breakout. If it's a longer lasting bull flag. So if you have a long drawn out kind of dip here, that last 2 hours of the day, around 2 to 4, is typically when you'll see that second attempt to break that high. That's if the high was not broken in like the first hour, because a lot of these you can actually see a break of that high right away. So you'll see the rise in price, the rise in volume. You'll see that pullback in volume. This will all be happening in minutes. This will all be happening within the first hour. Then you can either enter on the pullback if it has a decrease in volume, if it's still above the 12 moving average, if the MACD is still bullish, so we haven't crossed down, if the Momo is still bullish, then you can enter on a good candlestick pattern. You want to look for a bullish candlestick pattern, obviously. Something like here, we had a morning star, which kind of failed. You had a morning star there. You also had a somewhat morning star here, bounce off the 12. This one was below the 12. You also had a break there. You had a good test there. So these are the candlestick patterns you want to look for when you're testing that pullback range towards the 12 moving average. So your entry is going to be either right away on the break of pre-market highs. So let's say if this was pre-market here, that would be your pre-market high. You're entering on a break of pre-market highs on a surge in volume. Typically, when you're using this kind of a screener, you won't be able to enter on that break of pre-market highs because it won't register as a 5% gain, or it won't have the relative volume, or it won't have the volume to fit it into the screener. So the screener won't actually catch it until it kind of breaks that pre-market high. So if you miss the break of the pre-market high, you want to trade the first major pullback of the 12 moving average. But you want to make sure the price and volume are lining up. So let's say this is your pre-market high. This is your opening bell. Your bell breaks the pre-market high. This is your first attempt to enter. If you miss this, you want to enter on the first pullback. But you don't want it to be a major pullback. You want it to maintain that bull flag pattern. So you want it to be, if we were doing a Fibonacci, you want it to be above the 50%, typically even above the 382. So when this pulls back, you want it to remain above the 50 and then start to curl. You want it to have low volume on the pullback, and then you want it to have rising volume with the rise in price. This is your second attempt to enter. Your stop loss is a close below the 12 or a hard stop loss based on a centage. So what I use is I posted this in Discord. Let me pull it up. I have a full guide on stop losses and targets that I use. So for stocks ranging from $1 to $3, I risk 8 cents and I target 24, sell half, target 40, sell the remaining. If the 3-to-1 target is hit and the 5-to-1 target failed to be hit, I sell the remaining at a 1-to-1 or break even. So if it's a stock ranging from $1 to $3, which this one would be, when this one opened, it was starting at $1.40. So that is in my $1 to $3. I would be risking 8 cents. I would be targeting 24, or I'd be targeting 40. That might sound very outlandish to some of you guys, but if you trade penny stocks on a day-to-day basis, you understand that if these bull flags play out properly, that is not outlandish at all. You can easily see a 10, 20 to 30% gain on these penny stocks. Now, they're not all going to look like this. They're not all going to look like, where did this open? This opened here. This gave you nearly a 250% gain. It gave you a 230% gain, $3. They're not all going to look like that. The vast majority are not going to look like that. But the vast majority will give you that 3-to-1 or 5-to-1 risk to reward, even if you're risking like 10 cents. You want to make sure you're trading with the proper risk management, obviously. If your account is, say, $100 and you're trading all $100, you don't want to be taking a 50-cent loss or a 20-cent loss because you'll lose a mass majority of your account. So if you're trading something like a $500 account and you're trading the whole account and you're risking, say, 8 cents, 10 cents, you're not going to lose very much. You're going to lose a big portion of your account percentage-wise, typically not as much as you want to be trading with on a normal account. But this is a very high risk, high reward trading setup. Trading penny stocks is very high risk, high reward. So if you're looking for something that's very simple, or I shouldn't say simple, if you're looking for something that's very laid back and kind of, you don't have to watch the charts you don't have to look for those big moves. It's kind of like swing trading, very relaxed, not risky if you're playing the right patterns. This is not the technique for you. If you're looking for something that's really high risk, high reward, if you're looking for, let's say, 10% gains a week, then you're going to look to trade penny stocks. I don't recommend trading penny stocks for anybody that is not tolerant to risk. So you definitely want to be risk tolerant. But going back to what I was saying, so you have your first entry on the break of pre-market highs, second entry on a curl of the flag, or third entry on a break of the top. Any entry after this is very risky and is more like FOMO. You don't want to FOMO into these. First entry, break of pre-market highs on high relative volume. Second entry on the pullback of the bull flag on low volume. You have high volume on the price move up, low volume on the price move down. And then it starts to come back as price starts to rise. That is your entry. And then if you miss that, your entry is a break of your bull flag high. So if this is your bull flag here, that's your break of the high. This one actually faked you out a little bit. So depending on what your target was, you might have got stopped out on that one. That gave you a 22-cent target. So you might have got stopped out on that. You probably would have stopped out break even. You would have re-entered on a break of this high or this high again. So your entry would have been either here or up here. And then you would have targeted your gains, so your 24 cents or your, what was the other target? 40 cents. That's if you're trading $1 to $3, which this one is. Or you can use a trailing stop, which is the 12 moving average. A close below the 12 moving average is your stop. This one, you would have probably closed at the end of the day because obviously you don't want to hold these for longer than the day unless you're avoiding the PDT rule, which I'll go into later. But you don't want to hold these overnight. You do not want to hold any stocks overnight. They typically get very volatile in the next day's pre-market if they had a big surge the previous day. So just a small recap. The only pattern that I look for when trading penny stocks is the bull flag. If it does not have this pattern, I do not trade it. Now, some of you guys might think, wow, you're limiting yourself by a lot. You're probably not trading very often. Back when I used this technique, you can typically find these patterns at least once a day. Most of the time, you can find them 2 to 3 times a day. This pattern is very common in penny stocks. If you maintain the proper risk to reward, 3 to 1 to 5 to 1, it's not hard to only trade this pattern and be profitable. You're not cutting yourself out of most of the market. You're just being picky because you know how to trade that pattern. So you look for a bull flag on your screener. If you don't see any bull flags, you don't trade. You look for a break of pre-market highs. You look for a pullback and a curl, providing that bull flag pattern. Second entry. Or you look for a break of the top of the flag. All 3 of these entries should be relatively close to your 12 moving average. If it attempts to break the high very far away from the 12 moving average, You can still enter, but it's going to be a lot riskier trade. You want your 12 moving average to be providing support right below your flag pattern. You also want to confirm the volume. High volume has prices rising, low volume as price is falling, and then a high volume once again as price is recovering to break that high. When using the MACD, for you guys who don't know how to read the MACD, I have default settings. Let me bring it up. Default settings. This is built into TradingView. The blue line, when it's above the orange line, is a bullish pattern. When both lines are above the midline, that is an even more bullish pattern. So this is basically a very strong uptrend, but it can be uptrending below the signal line, which is the midline. So this is an uptrend. This is a very strong uptrend. Same goes for vice versa. So when the blue line crosses below the orange line, this is a bearish pattern or a downtrend. If it's downtrending below the signal line like it is here, that is a strong downtrend. And you can also use this for divergence, but I'm not going to get into that because that's not what I'm going to be teaching my IRL friends, because it's not really something you need when trading this technique. So just know that when it crosses up, it's bullish. When it's trending up above the midline, it's extremely bullish. When it crosses down, it's bearish. When it's trending downward below the midline, it's extremely bearish. Or extreme is kind of a strong word, but it's a stronger trend. And then the Momo I'm not going to get into in this video because it is very complicated. But basically, you want to have the two Momo lines trending with your price. And you want the lines to be relatively close together. So that is basically it for the technique. It's not complicated at all. You look for bull flags. You make sure you are trading with the volume. You make sure your 12 moving average is providing you support. You make sure your oscillators, whatever you're using, RSI, MACD, Momo, you make sure they're providing you support. And you make sure you're managing your risk. So I'll go over what you want to be doing with your risk. If you're following this setup, just go to my Discord and look at equities updates. I have it all laid out for you, but I'll go over it here. Stocks between $1 to $3, you want to be risking 8 cents or around that number, depending on how big your account is. But that is what I'm going to be using. 8 cents. You target 24, that's a 3-to-1 trade. And you target 40 cents, that's a 5-to-1 trade. For stocks ranging $3 to $5, you want to be risking 16 cents. Target 48, that's 3-to-1. Target 80, that's 5-to-1. Stocks ranging from $5 to $7, you want to be risking 24 cents. Target 72, 3-to-1. Target $1.20, 5-to-1. If your 3-to-1 target is hit and your 5-to-1 target is failed to be hit, you want to sell the remaining at a 1-to-1 or break even. When I say 1-to-1, I mean if you're risking 8 cents, you sell at an 8 cents profit. If you're risking 16, you sell at a 16. If you don't want to sell at a 1-to-1, if that doesn't seem like a good stop loss according to the price action, you can sell at break even. That is for the remaining half. You should have already taken half on your initial profit. So that is it for the stock trading setup. Now I'm going to go over the second technique that I've been using on Bitcoin. Let me remove everything from my chart. We're going to use the BitMEX chart. I typically look at a 15-minute or a 30-minute for this technique. Very, very simple. First thing we're going to do, we're going to grab the high of the previous day. Make sure you're in magnet mode. Go to the daily. We're going to grab the high of the previous day. We're going to grab the low of the previous day. For the high I use red, for the low I use blue. And then we are also going to turn off magnet mode. We're going to go in here to 15-minute. Grab a Fibonacci to make this easier on yourself. And we are going to grab the 50%. And I make this pink. So this is our previous day's range, basically. This is our high of day. That's our low of day. This is our mid of day. Or you can call that your equilibrium. Now, I also use this technique VWAP. You can use the built-in. Basically, what I use is just a VWAP that turns green when it's rising and red when it's falling. Okay, so for this technique, you want to see where is price trending according to yesterday's range. So yesterday's range, we have the highs up here, the lows down here, and then we have the equilibrium around here. So when today opens, which it opened here with this blue line, where is price ranging? Price is ranging to the lows of yesterday. So this little swing low that we have here, this little descending kind of wedge, it is descending towards yesterday's lows. We have lows here, and lows here. Typically, if price is descending towards yesterday's low, sorry, I forgot something. Let me pull up volume. If price is descending towards yesterday's lows and it's trending below VWAP, if we do not have high volume, it will not be strong enough to break yesterday's lows. So, therefore, you want to be longing the support. By support, I mean yesterday's lows. Let me move this down a little bit. So you want to be longing support. This is your support. This is the range low of yesterday, the previous day. If we are trending below VWAP, but we have extremely low volume, it is typically not going to be strong enough to break yesterday's lows and create a new low. This right here below this blue line is clean lows. That would be a break of the daily low. You would be entering a clean low territory, meaning that is a low that has not been tested. There is clean liquidity there to be grabbed. Typically, when you see those moves towards clean lows, towards liquidity, you will see a high surge in volume. If you do not see that surge in volume, you are okay to buy support. So buying this support with a stop loss below clean lows is not a bad trade. Now, if you start to see a surge in volume as price is decreasing towards yesterday's lows, then that is not a good way to buy the support. So here, once we start to break VWAP, you can see the volume starts to increase. This is your support from yesterday. If we start to break out of that support above VWAP with good volume, that is a very strong buying setup. This is basically exactly what you want to look for. A break out of this yesterday's support above VWAP with an increase in volume. You are going to target equilibrium or yesterday's range high, or you can target both of them. You don't have to target them exactly, so you don't have to set a target at 42.99. You can target yesterday's resistance. So look for where that resistance block is that created that daily high. So right here we have a resistance block of about, not letting me use the price tool, of about 2%. So this 2% resistance block can be where you're targeting. You could target the equilibrium, you could target the high, you could target the low. Typically, the closer to where price is now is going to be the safer target. So look for where is the resistance that created yesterday's high. That becomes your target area. You can also sell part of your trade. Don't sell all of it unless it's a clean rejection. But you can sell part of your trade on the test of equilibrium. So when price starts to break through equilibrium here, you would sell part of your trade, probably 30 to 50%, unless price started to hard reject your equilibrium. If we started to break below VWAP, then you would close probably the remaining of your trade. But as long as it's remaining above VWAP and it's not hard rejecting the equilibrium, you are safe to hold on to the rest of your position. The same goes for the sell setup. The sell setup, which I'm glad Bitcoin cooperated here. This made this video very easy. The sell setup is just the opposite. You want to be using the resistance from that daily high as your entry point, as long as you're not breaking through the daily high. If price is decreasing or very low inside of that resistance point that created that daily high, then you are safe to sell that high. You are selling resistance. So you would have sold this here. Your stop loss is above the daily high. That is going to be acting as resistance to protect your trade. And then the same targets. You're targeting equilibrium or the daily low from yesterday. If it is hard rejecting the equilibrium, same thing, you want to close the rest of your trade. Or if we are showing signs of a reversal, you want to close the rest of your trade. Now, this is not a perfect setup because we're still kind of in a bullish VWAP. Let me see if I can find a better bearish setup here, because we've been quite. Actually, here's a better setup. I'm going to get rid of these lines here. So we're going to do the same thing, but for yesterday. Let's pretend like today didn't happen. So we're going to go back into magnet mode. We're going to grab the previous day's high. We're going to grab the previous day's low. We're going to go down to a smaller time frame, take off magnet mode. And we're going to grab the equilibrium. You can do this however you want, but I do it with a Fibonacci. It's very easy. And then just grab the 50%. So now we have yesterday's range. We have the highs of yesterday, we have the lows of yesterday, and we have the equilibrium. So your bearish setup here would be typically selling the highs and then covering the mid, covering the lows. But look at how weak this is. This is a very bearish setup of this technique because we are failing equilibrium. You can see here, it starts to get choppy around the equilibrium. It's bouncing between the equilibrium and VWAP until it finally breaks VWAP and the equilibrium on this candle here. Sorry, let me go back. So we broke equilibrium on this candle here, along with VWAP. So now we are trading below equilibrium from yesterday. We are trading below VWAP. VWAP is acting as resistance. Equilibrium is acting as resistance. So we can sell this here. Let's actually pull up volume, sorry. We also, look at this, we have a surge in volume as well. So we are breaking equilibrium. Or I shouldn't say breaking, I should say rejecting. We're rejecting equilibrium. We are breaking VWAP. VWAP is acting as resistance here. Equilibrium is acting as resistance. So this is your sell setup. If you did not sell this candle here, you would have sold on this candle here or the pullback. This is a perfect bear flag because we are seeing a surge in volume when price is falling, and we are seeing a decrease in volume as price is consolidating. Another thing to mention, if price is consolidating directly below VWAP, if it does not have a lot of volume, it is typically not going to break VWAP. The same is said for the upside. If price is consolidating above VWAP and it doesn't have a lot of volume, it is typically not going to break VWAP. Because what people do with VWAP is they use it as a buying and selling point, depending on where price is according to it. So if price is above VWAP and it starts to fall towards VWAP, if there's not a lot of volume and VWAP is pretty much sideways, it's pretty easy to trade a long there. If price is consolidating above it, VWAP is sideways, you don't have a lot of volume, you're pretty safe to buy VWAP. You can go back and back test that through most consolidation days. Most days of consolidation when VWAP is sideways, if your price is hovering above it, you're pretty safe to buy it. If price is hovering below it, you're pretty safe to sell it. So since we do not see a lot of volume here and we're consolidating below VWAP, this becomes the bear flag. So that's another sell point. So using this technique, you would have sold the rejection of equilibrium, or you would have sold the rejection of VWAP plus the equilibrium. You would have targeted yesterday's lows. If it does not find support on yesterday's lows, then you would look for previous lows. Let's go back to the daily. So sometimes I only grab one day, sometimes I grab multiple days, depending on how big the candles are on the daily. So here, let me go back to magnet mode, sorry. Here is the next previous day. So we're pretending like we're trading this red candle. This is your previous day. This is your previous day before that. There you have another low. You grab it. I use blue. You can grab the high as well. The equilibrium you don't need to really worry about, but if you want to, you can go ahead and grab that as well. That would be the equilibrium of this day here. You can see it's divided by these two blue lines. So once again, you just grab your Fibonacci tool. You grab the low to high, and you go ahead and grab the 50%. Okay, so now that we have some more data here, we are trading during this trading day. So we have the previous day and the day before that. So you would have sold somewhere around here. Your first target would be the low of day of the previous day. This actually lined up almost perfectly with the equilibrium of 2 days ago. So then your next target would be the low of the previous day. So we have 37.69 as our next target. Now, like I said before, you don't have to target these exactly. You're not going to put your target at 37.69. You're going to go back and see how that is a low of day. What is creating that low of day? So right here we have consolidation. Then we have some resistance back here that helped that consolidation. You have a lot of support down here. So you typically don't want to put it below that support. You want your target to be above that support just in case we come down and bounce off of it. So if I was targeting this, I would have put it above the support. So let me grab the support. You would have put it above the support. So depending on how far above the support you put it, you might not have got hit. If you would have put it like right there, you wouldn't have got hit, depending on where you traded this. If you would have put it on the support, you definitely would not have got hit. But you don't want to just put your targets there and then leave them alone and not watch price action. Because once you saw this start to make lows and reject your target, you could have closed your trade. So you see a massive drop here, but then look what it does. Bottom, double bottom, triple bottom. So that is clearly a support. If you're not closing a short there, I don't know what to tell you. That is clearly a support. It is finding a lot of buyers. If you don't close your short there, I can't help you. So you should be out of your trade either on this range here, or you should have gotten out of it when it retested your first target. So you shorted here. First target is low of day or the previous day's equilibrium. And then you close it on the next low of day or the next equilibrium or the next price target before support. But as I've always taught you guys, if your first target is hit and your second target is not hit, you close the remaining of your position on your first target. That is every single one of my trading techniques. Everything that I've taught you guys, bull flags, Fibonacci, anything. If it hits your first target, does not hit your second target, and retraces to your first target, you close. It is one of the easiest ways to trail a stop. Now, yes, sometimes you might get stopped out a little early, but it is one of the best ways to protect your profit. I'm just going to quickly recap if you're just coming in. I'm going to quickly recap this technique. Let me remove all the drawings. So what we do with this technique, grab magnet mode, grab your raise, you grab the low of day, you grab the high of day, you go to a smaller time frame, you go back, you take your Fibonacci tool, you go from low to high, you grab your equilibrium, which is your 50%, Make sure you color code these so you know what you're looking at. I use red for high. I use blue for low. I use pink for equilibrium. Once you have all that set up, you look for your bullish setup, which is support around low of day, which we saw here. This is your support block. You look for support around low of day. You look for a break of VWAP, surge in volume, confirming your support. That is your buy setup. You target equilibrium. You target the resistance that created your high of day. That is your buy pattern. You can also use a buy pattern that I did not go over, is a bounce off equilibrium. So if we're downtrending and then we start to show signs of support off equilibrium, let's say VWAP is below, you could buy that as well. If equilibrium is providing support along with VWAP with good volume, that is also a buy setup. Your bearish setup, let me grab the levels. You grab your high of day. You grab your low. You go to a smaller time frame. You grab your equilibrium. Once again, you want to color code them. Your bearish setup is just the opposite. You want to be selling resistance that created the high. You want to be selling rejections of equilibrium and VWAP. You want to be targeting lows of day, either on the previous day or the day before it. And you want to be taking profit in 2 steps, basically. Equilibrium is your first step if you're trading the high of day or the low of day. And then your high of day or low of day becomes your second step, take profit. As always, you want to be doing basic technical analysis to confirm your buys and your exits. But that is the overall technique. It is more of a patient kind of swing trading technique. You're not nitpicking exact levels. All you care about is where that daily range is. So for people who don't like to go in and do this and kind of find like every single level and find like every low and every high, people who don't like to do stuff like that, this technique is much simpler because all you care about is the 3 levels of the day. You care about the high, you care about the low, and you care about the equilibrium. And you want to see what your price is doing according to those 3 levels. So that's it for those techniques. Hope they made sense. This is going to be a VOD on my YouTube, so if you missed it, or if you have to go back and kind of watch it again. I know sometimes I can be a little scrambled when I'm teaching these things. I go off on tangents, but if you have to go back and watch it again, please feel free. If you guys have any questions, just post them in the comments or message me on Discord. Obviously, there's more to every single technique that I could go over, but that is the overall stuff that you need to know. The reason I don't go so in depth with these techniques is because if I give you the basis of the technique, you guys are always going to throw your little flair onto it. You're going to throw in some indicators you like to use. You're going to throw in some techniques that you like to use. For me to sit here and tell you step by step every single thing that goes into these techniques, it's not really worth it because you guys are going to change it according to your style anyway. So it's best for me to just give you the overall aspect of the technique, allow you to kind of tie it to your trading techniques. If you guys have any questions, like I said, you can post them in chat. I'm watching the chat right now. Or you can just post them in the comments after the fact, and I will happily answer them. We're actually seeing a bounce off VWAP here on the close of day. Close of day was on about 10 minutes ago. But while we're watching this, what's going on, Seraphic? Yeah, I'm trying to stream on YouTube. I wanted to make sure I got my YouTube working before I did the dual stream. So now that I have the YouTube working, I know Twitch works. Next time we stream, we're going to be dual casting. I wanted to make sure my YouTube was working before I dual casted, because last time I tried to stream on YouTube, it gave me error after error. It said my bitrate wasn't good. It said my internet wasn't good. It said my audio wasn't good. It was giving me all kinds of bullshit. But yeah, so next time we stream, probably will be I don't know actually. Probably either midweek next week, probably around Wednesday, or probably Friday or Saturday. I will be uploading my Bitcoin weekly update video tomorrow. But I don't see any questions in chat, so I'm going to go ahead and end it on that, guys. If you guys like the video, if you haven't already, please subscribe. I will be doing more of these streams, probably at least once a week. That's what I hope for. And they will be dual streams. So if you guys don't follow me on Twitch, go check me out on Twitch as well. It's Deja Brew Trades, not trading. So make sure you change that. But yeah, I'd love to see you guys next time. So hit that subscribe button, and I will catch you guys later.